The Hidden Cost of Every Sale, Mastering Merchant Fees, by avibusinesssolutions.com. A sale hits your register for $100, but the deposit that lands in your account is less. That gap is where credit card processing fees show up, and for many small businesses, it adds up faster than expected. If you accept cards, understanding those costs is not optional, is part of protecting margin, managing cash flow, and choosing the right payment setup for growth. What credit card processing fees actually include. Credit card processing fees are the charges tied to moving a card payment from your customer to your business bank account. Most merchants see a single blended rate on a statement, but that number is usually made up of several components. The largest piece is often interchangeable. This is set by the card networks and paid to the customer's issuing bank. Then there are assessment fees charged by the card brands themselves. On top of that, your payment processor or merchant services provider adds its own markup to cover transaction processing, risk management, and payment technology. That is why two businesses can both take cards and still pay very different rates. Your costs depend on the types of cards your customers use, how you accept payments, your average ticket size, your industry, and the pricing model associated with your account. Why fees vary more than most business owners expect. A coffee shop, a medical office, and an online apparel brand do not present the same risk or transaction pattern. Card-not-present payments, like online or phone orders, usually cost more than in-person chip transactions because fraud risk is higher. Rewards cards can also carry higher interchange than basic debit cards. Ticket size matters too. If your business processes many low-dollar sales, flat per transaction fees can take a bigger bite out of each payment. For larger transactions, percentage-based pricing tends to get more attention. Neither is good nor bad on its own. It depends on how your business sells. Timing also affects cost. If you batch transactions late, key in cards instead of using a terminal, or fail to submit the right data for business or commercial cards, you may fall into more expensive qualification categories. Small operational details can quietly raise your effective rate. The main pricing model merchants see is flat rate pricing. Flat rate pricing is simple. You pay the same published percentage and per transaction fee for most sales. This model is common with plug-and-play payment platforms because it is easy to understand and fast to activate. The trade-off is that simplicity can cost more if your business processes enough volume to qualify for more customized pricing. Flat rate plans are often a good fit for newer businesses, seasonal sellers, or merchants that want speed over fee optimization. Interchange plus pricing is an interchange plus pricing separates the direct card costs from the processor's markup. You pay the actual interchange and assessment fees plus a fixed markup. This model gives you more transparency. It often works well for established businesses that want to understand exactly what they are paying and where savings are possible. The downside is that statements can look more complex and monthly charges may feel less predictable if your card mix changes often. Tiered pricing. Tiered pricing groups transactions into categories such as qualified, mid-qualified, and non-qualified. It sounds straightforward, but comparing them can be harder because the rules behind those categories are not always obvious. For some merchants, tiered pricing works fine. For others, it creates uncertainty because too many transactions land in higher cost buckets. If you are offered tiered pricing, ask for clear examples based on your actual sales profile, not just a low advertised starting rate. Hidden costs that deserve a closer look. The headline transaction rate is only part of the story. Monthly statement fees, PCI compliance fees, gateway charges, chargeback fees, batch fees, early termination penalties, and equipment costs can all affect what you really pay. This is where many businesses lose money without realizing it. A processor with a slightly higher transaction markup may still be the better value if the account is cleaner, the support is better, and the contract is easier to work with. The cheapest advertised rate is not always the lowest total cost. It also matters how hardware is sold. Leasing terminals can become expensive over time, especially for small merchants that could buy equipment outright for far less. Before signing anything, review the total annual cost, not just the monthly teaser rate. How to calculate your effective rate. If you want a real picture of your card costs, calculate your effective rate. Divide your total processing fees for the month by your total card sales volume. Then multiply by 100 to get the percentage. For example, if you processed $20,000 in card sales and paid $700 in total fees, your effective rate is 3.5%. That number is often more useful than any quoted rate because it reflects what you actually paid after markups and account charges. Track this over several months. A single month can be misleading if you have unusual volume, more keyed-in transactions, or an unusual number of premium rewards cards. How to reduce credit card processing fees without slowing sales. Lowering costs is possible, but the right move depends on your business model. The goal is not to chase the absolute lowest rate. It is to generate more revenue while maintaining a payment experience that customers can trust. Review your pricing structure for a better rate. If your business has grown, your old setup may no longer fit. Many merchants start with a fast approval platform and stay there long after volume justifies better pricing. A pricing review can reveal whether an Interchange Plus or a custom merchant account would lower your effective rate. Encourage lower-cost payment behavior carefully. Debit transactions often cost less than credit transactions, but most businesses cannot control which card a customer pulls out. What you can control is convenience. In-person chip readers, tap-to-pay acceptance, and properly configured terminals help route transactions in the most efficient way available. For some businesses, cash discounting or surcharge programs may also come up. These can reduce the merchant's share of card costs, but they need to be handled carefully. Rules vary by state, card network, and processor, and customer experience is a factor to consider. A pricing strategy that saves fees but irritates loyal buyers may not be a win. Tighten operational habits around credit card processing. Train staff to avoid unnecessary keyed entries. Close batches on time. Ensure business and commercial card transactions include the required data fields to qualify correctly. If you bill recurring customers, use secure tokenization and updated card information tools when available. These are not flashy changes, but they can improve acceptance and reduce avoidable downgrades. Watch out for chargebacks and fraud. Fraud prevention is part of cost control. Chargebacks do not just create fees, they also increase risk exposure, and too many can push a merchant into worse pricing or account restrictions. Use address verification, CVV checks, customer communication, clear billing descriptors, and order documentation where appropriate. If you sell online, invest in a checkout process that balances convenience with risk screening. Choosing a processor based on value, not just rates. A good payment partner should do more than quote a low number. Setup speed, funding times, contract flexibility, reporting, support quality, and integration with your POS or online store all affect your operation. If you need fast access to deposits because payroll, inventory, or ad spend cannot wait, funding speed matters. If your business is growing across channels, you need a processor that can handle in-person, online, mobile, and invoice payments without turning reconciliation into a weekly headache. This is where a solutions-focused provider can make a real difference. AVI Business Solutions supports businesses that need practical payment infrastructure alongside broader cash flow and growth options, which matters when payment acceptance is just one part of the bigger financial picture. When paying a little more can still make sense. Not every fee increase is a bad deal. A processor with stronger fraud tools, better customer support, faster deposits, or easier integrations may save money elsewhere in your business. The same goes for contract terms. A month-to-month account with clear pricing can be worth more than a lower rate locked behind a long agreement with penalties. The smart question is not, what is the cheapest rate? It is, what setup gives my business the best net value? For some merchants, that means aggressive cost-cutting. For others, it means paying slightly more for speed, reliability, and fewer operational problems. Credit card acceptance should help your business move faster, not quietly drain revenue in the background. When you understand how fees work, ask better questions, and compare total value instead of headline rates, you put yourself in a stronger position to protect margin and scale with confidence.
Running a small business means being ready for anything, but what happens when the big banks say no? At AVI Business Solutions, we say yes.